What if I told you that the fewer trades you take in a month, the higher your chances of ending that month in profits? In trading, less is more. This applies not just to the number of trades you take, but also to your entire strategy. Simplifying your trading approach and ignoring all the noise in the market can completely transform your results. Think about it. Why waste your time chasing low probability trades when you can focus on high quality opportunities? Let me show you a strategy that's not only highly profitable, but also incredibly easy to learn, even if you're just starting out. This strategy is called the one shot, one kill model. This strategy can work for short-term trades, day trades, and even scalping. No complications, no unnecessary indicators, just pure price action and smart money concept. Stick around because by the end of this video, you'll have the tools to approach the market with clarity and precision while taking fewer trades and making more profit. Let's dive in. And this is a short-term trade lasting for about 3 to 5 trades. You're looking to capitalize in bulk of the move in a weekly candle or in a weekly range. And this model consists of 4 processes, which include the weekly bias, the power of 3 plus protraction, the institutional level, and then your entry. And I'm going to be taking you through this process using an example. So let's see that quickly. Now, the first thing you want to do is the weekly bias. You want to try to determine which direction will the subsequent week extend towards. Is it going to be bullish or bearish? Now, when it comes to bias, I would like to let you know that it is not a step 1, step 2, step 3 kind of thing. Bias has to do with a lot of practice and experience. There is no quick fix anywhere to bias because bias has to do with a lot of things. You combine market movement, market structure, liquidity, institutional levels, and order flow. These things help you refine the probable bias. Market condition is not always similar. Like as you see how price is printed here, it's not always, you don't see a replica of this. So if price will always move in this form, I would be able to tell you that once you identify this and that, the bias will be bullish. And if you don't see that, it will be bearish. But you can see, unfortunately, market or price is not like that. We have different unique scenarios when we look at our chart. So you can see here, what do you think will be the next candle that we printed? So pause this video and try to guess. Is it going to be bullish or bearish? Because that's the first thing you want to do. You want to determine the weekly bias. Where is the next week going to extend towards? Bullish or bearish? I want to trade that week. I want to maximize the bulk of that week's expansion. So if you said bearish, then you are correct. You can see how this week candle extended downwards. Now, what are the things that could help you know that market wants to go bearish? All factors that will be in the favor of market going bearish than bullish. The first thing is liquidity. Market movement is primarily determined by liquidity. Market seeks liquidity. And one thing we should understand is there's an algorithmic tongue twister pattern of liquidity delivery. And I've taught it before. I'll leave a link by this side of the video so you could go watch. It is external range liquidity and internal range liquidity. Price moves from external range liquidity to internal range liquidity. You can see there's a fair value gap here. So what do you expect to happen here? You can see this is an external range liquidity. So price has taken it and there is a fair value gap. So you can see how price moved into this fair value gap. This fair value gap is an internal range liquidity. So as soon as price gets into this internal range liquidity, where do you think price will likely go? The external range liquidity. So this is the next drawn liquidity. Another way of looking at it is, let me just take it out. Now, this is where, let's go back. Now, this is where price is currently. I'm looking forward to use the one shot, one kill model for the next week. Where's liquidity? Now, you can see here, we know that liquidity rests above highs and below lows. So you can see here, this low, okay, correct. This low is sell side liquidity, this is buy side liquidity. And then there's a fair value gap here. There's a short-term high, there's a high, there's a fair value gap here. So these are all the liquidities we could have outlined in this range. And probably maybe there's an old low here also. I don't know. But now you want to identify all the liquidity that you can see. And this is a weekly time frame, guys. You don't want to be using all this that you can see here because It's too far away from price. It will be highly unlikely for price to start reaching out for. Now it can, but it will take a lot of time. You're just looking out for the next week to be printed. So where is a likely place you think price will go? So if I take this out, the liquidity that we can see I'll be left with is this high and this low. So now these are the 2 points of interest. All right. So what do you want to do? You want to apply the liquidity delivery, the algorithmic liquidity delivery. We have taken what? Sales and liquidity with these two candles here. All right. Where do you think price went to next? It went to what? Internal range liquidity. So this liquidity has what? Returned. And you can see how price started falling. Price is reacting from what? An institutional level. All right. So now at this point, price is way close to the sell side liquidity. So we don't expect price to start going higher for this high. So this high is cancelled. The only point of interest we have now is what? The sell side liquidity. And you can see how price went there smoothly. Right. You see? Now you can see in determining the bias for this week, I combined a whole lot of things. But the very key factor I combined was liquidity and its delivery. Another very important factor you can also add is the three candle pattern. You can see here, this is 1, 2, 3. The three candle pattern is when the candle in the middle is higher than the candle at both sides, the left and the right. So you can see this is a short-term high. Now, when a short-term high is being created like this, it's being protected. Like the likelihood for price to go above it is very, very low. You can see it here. You can see it here. As soon as price, let me just explain. You can see how price took out this high and then formed the three candle pattern and then ran lower for what? This low. After that, what happened? It retraced back into what? The internal liquidity. If you go closely, you see that price touched. Because I remember when I took a trade here, I took a sell. One price went into this fair value gap. So you can see how price rallied lower. After taking another external range liquidity, it created what? Another three candle pattern. Because one of my previous video, I explained that when you see a three candle pattern, expect the next candle to be printed to be in that direction. So if you see a three candle pattern, let's say a bullish three candle pattern, expect the next candle to be bullish. So you can see it here. This 1, 2, 3. This candle was bullish. 1, 2, 3. This candle was bullish. 1, 2, 3. This candle was bearish, although not quite bearish. Let's see anyone. 1, 2, 3. This candle was bearish. 1, 2, 3. This candle was bearish. But if you see here, this candle has already been printed. So we still have one more candle. So if you look at it, this three candle pattern has not achieved its aim of taking what? This liquidity. So you can see here, as soon as this three candle pattern was formed, what happened? It took this liquidity before forming another three candle pattern. So all the candles were what? Bearish until liquidity was taken. Again, you can see this three candle pattern. They were all bearish until liquidity was taken. You can see this three candle pattern. They were all bearish. Now it doesn't happen like that all the time. These are just things you combine. You can see a lot of confluence, and I am combining to let you understand what will the likely bias be for the next week. And this comes to you with experience. So you have to go to the chart, you back test, you tape read, you as well journal your trades. This thing helps to improve your experience. Experience is something I cannot give you. You have to earn it yourself. And that's why you can't become profitable in just 6 months, 1 year, or whatever fallacy you may have in your mind. Even if you understand everything, you still need that experience because market is unique. There's never any true repetition of price movement. It will look alike, but it's never the same. Now we've gotten our bias, and our bias is what? Bearish. You can see the candle actually went bearish. Now let's move to the next step. Remember, this is step 1. So step 2. Step 2 is where we'll be applying the power of 3. All right. So now I'm going to be talking briefly on this power of 3 because I want to combine step 2 and 3. I want to teach them together because they go hand in hand. Now, for the step 2, you are expecting price to protract against the intended move. We already called the weekly bias bearish. Now we are expecting Monday, Tuesday, or Wednesday to go above the open. Now you can see here, this is our regular candle. The anatomy of this candle is it's been demonstrated here. You can see this is the open, this is the high, this is the close, and then this is the low of the candle. If it is a bullish candle, you will see the open at this point here, and then the close here. So if you go to your chart or your trading platform, you can change the candlestick to look like this. So once that week opens, you want to draw out your weekly open. That is the open price. And that is 12 a.m. New York time on Monday. Once you've drawn out the open price, the weekly open price, you are waiting for Monday, Tuesday, or Wednesday to go above the market open. This is where you want to be looking for yourselves. So if you would have called the market bullish, you want to wait for either Monday, Tuesday, or Wednesday to go below the market open and look for a buy. So step 3 is the institutional level. You want to pair that protraction with an institutional level. So you're expecting, so here will be the market open, this line here, because this is a bearish candle. So this, let me draw it well. This will be the market open. So as soon as market, that's Monday, as soon as it opens, as soon as it prints, you want to draw that line and then expect either Monday, Tuesday, or Wednesday to go above market open and then find a resistance where in an institutional level. So you can see here's a fair value gap. You can see how market went to it before running lower. Now, I'll say it again. Monday, Tuesday, or Wednesday. This is one shot, one kill. You're looking forward to capitalize on the bulk of the weekly range. Now, you don't want to be trading after Wednesday. Once it's Wednesday and you didn't get any trade for the one shot, one kill model, you stay in the sidelines or you take a day trade or a scalp. But for the one shot, one kill, you want to be looking for entries on either Monday, Tuesday, or Wednesday. As simple as that. Because the week has already ended. Monday, Tuesday, Wednesday is gone. You didn't get any trade. You don't want to be entering a trade Thursday. And Friday usually retraces back into the weekly range. So you're making less profits. You don't want to be doing that. You can take day trades on Thursday or scalps, but you don't want to be taking the one shot, one kill. Except you want to take a swing trade. Of course, you can do that, which is a different trade setup from the one shot, one kill model. But then again, in most complicated cases in price movement, you can as well trade on Thursday and Friday using the daily profiles like the Thursday reversal, the Seek and Destroy Friday. But these are well advanced concepts and it takes a lot of experience, a lot of price action confluences, especially the news. But then as a new trader, you want to stick with this simple one. You are waiting for Monday, Tuesday, or Wednesday. As simple as that. All right, let's move on. So this is a daily time frame. You can see this is Monday, Tuesday, Thursday, Friday. Now there's no Wednesday here because Wednesday was a bank holiday. That was the New Year, 1st of January. So there was no trading. So we can see that the high of the week was formed on a Monday. It was Monday that expanded into what? Our institutional level. So this is the weekly fair value gap high, the weekly fair value gap low. And then we can see how price took out what? The sell side liquidity. This is what we call relatively equal lows. To recap all I've said, you have to determine the bias. If the bias is bearish, once Monday opens, because Monday is the first day of the week, you want to outline your market open. And I said it's 12 a.m. midnight, New York time. Now, once you've identified the market open, you want to wait. Monday, Tuesday, or Wednesday could form the high of the week. Now, how do you know which? That is why we're combining what we call the institutional level. We are looking at this point to see if there's any order block, fair value gap, or breaker block. Now, what time frames are you going to be using? You can use from the weekly time frame down to the 4-hour time frame. You don't want to go below that. The weekly time frame to the 4-hour time frame, you're looking for what? PDRAs. You're looking for institutional levels. So now let's say Monday rallies higher, but did not get to the other block. You don't want to be using that Monday. You want to wait for Tuesday or Wednesday. And if Tuesday doesn't rally up to that institutional level, you wait for Wednesday. Now you may ask, what if this rally that happened here was the high of the week and you missed the trade? That's fine. You wait for another opportunity. It's normal when you miss trades. It happens. So you want to be on the safer side. You don't want to enter trades and then end up losing. So you are combining these two factors to give you an edge. So you are waiting for what? Monday, Tuesday, Wednesday to reach your institutional level above market open. Now, this will work perfectly if you have already determined the likely bias. And earlier, you could remember that the bias for the week is bearish. Where do you take your profits? You look for what? Liquidity below old lows, fair value gaps. Using what time frame? This same time frame. You can also use the 1 hour time frame for what? Take profits. Now, I hope that's clear. So let's move on. So this is the 1 hour time frame. You can see this is the market open. This is Monday. See how Monday protracted against the intended move. Market was bearish, but Monday was bullish at some point. You can see this is the weekly fair value gap. You can as well see how price is taking out what? Buy side liquidity before running lower. Price is what? Above the weekly open. So this day, you want to be selling. So there's another concept that also increases the likelihood of price running lower. It's called what? The SMT divergence. So you can see price. This is the Euro USD. See how it took out this high. It was forming a higher high. But the dollar index failed to form what? A lower low. So there is what? SMT divergence between the Euro USD and the DXY. So this concept already increases likelihood of price running lower for the euro and price running higher for the dollar. So now let's go back. Looking at this, I want you to pause the video for a moment and tell me what you see. Try and outline the things that you can see going from Monday, Tuesday, Thursday, and then Friday. Okay, so I hope you did that. So let's move on quickly. All right. So this is Monday, this is Tuesday, this is Thursday, and this is Friday. You can see Monday above the market open. This is the weekly open, and then this is Tuesday. Now, there are two forms of entry, as you can see here, the aggressive and the conservative entry. Sometimes you get the two, sometimes you get just one. And then sometimes you may get like 3 opportunities to enter, which is Monday, Tuesday, and then even seeing an opportunity on Wednesday. But you want to make sure that your entry is very, very close to the market open because it's actually common sense. If market is going to go lower, usually you don't expect the close to be at the open, except that week is did not expand fully. Now, if you have a full bulk week, even if price opens here and then close here, you can still make profit, especially when you see candles like this. I said this is a bearish candle. It has this wick, both wicks extending at both direction. Probably if you entered here, you would have sold and then bought back, coming out of the trade before price retraces into the range. Very simple. So now, if you look at this here, we have the aggressive and then the conservative. How do you go about the aggressive? As soon as price hits your what? Institutional level above the weekly open, which if for a bearish market, you want to go down to what? A 5-minute time frame and look for an entry. And we're going to do that very soon. But you can see here on Tuesday, if you'd have missed this, Tuesday give another opportunity. All right, you can see price reacting from what? This breakout block, this fair value gap, and then this consecutively up close candle. So a lot of confluences, and it's very close to what? The weekly open. So if price is very close to the weekly open, it doesn't mean that price must always be above the weekly open. You would also want it to be above anyway. But you must not enter above. Let's take, for example, this is the market open. You want to sell. Let's say price goes above, and then price at this point. You mustn't say to yourself that since price has gone above and is below already, you can't sell. No, you can still enter. You've seen this already. This is a signal telling you that, okay, the price has gone above the market open and definitely wants to, because this is all algorithm. Price usually goes against the intended move before going lower. So it doesn't mean you must always enter above for a bearish market or below for a bullish market. If you've seen this already, telling you that price has already gone above the market open, at this point here, you can also be selling because it's very, very close to the market open. It's only when price starts going lower, very far from the market open, you want to be careful not to go into that trade. So it's very, very simple. All right. Now, another thing I want us to note here is you can see this aggressive move. See this displacement with the creation of what? Fair value gap. Now, this is happening after when liquidity has been taken. Now, whenever liquidity has been taken, you see this huge move. It's telling that price wants to go in that direction. This here is not what small traders can do, although this is a 1 hour time frame. But when you see a move after liquidity has been taken like this, and that's why the ICT 2022 model works very fine. And you can see it here. I think I should clean this out. You can see here, price took out what? Liquidity, broke structure, created fair value gap, and you can see how Tuesday ran into that fair value gap before running lower. So you could be this type of trader that uses this concept or the aggressive. Now, mind you, I said before, you might not get these two opportunities. At times, you might only get the aggressive. So it will be very okay for you to learn the two. So you can see something happened here again that I want to explain. I still calls it a tree train pattern. You can see how price rallied up, retraced, rallied, retraced, rallied, then fell. When you see this pattern, it's just like when price is rallying slowly towards an old high or an old low. When you see this pattern, expect the third or the fourth fall to be aggressive. The same thing happened here. You can see this is 1, 2, 3, then boom, market fell. So usually it's another telltale sign that price wants to go lower. Now, these are confluences already, like a lot of confluences. This is a Monday, Tuesday. So I told you before, you're waiting for Monday, Tuesday, or Wednesday for price to run lower. Already there's no Wednesday. Wednesday was 1st of January, the new year, 2025. And I welcome you all to the new year, guys. And you can see here, this is what a breaker block. This is what another block. This is what again a fair value gap close to what the weekly open, and price has what formed what smart money divergence, telling that price wants to go lower. Another thing again, if you go back to previous slide, you see that what there was liquidity. What is that liquidity? Relatively equal lows. Relatively equal lows, to me, on my own experience, are quite stronger in pulling price than just a single low. When you see something like this, relatively equal low like this, the one most recent higher than the one further behind in time, something like this, relatively. That's what the name relatively. It doesn't mean they are equal lows. They are relatively equal lows because you can compare them together. You can't compare something like this. No, this is too far away, but these are relatively equal lows. We want to say that this low has not been taken by the most recent form low. So when you see something like this, it's a strong pull for price. And we saw that, but let's go there. Let me just show it to you quickly so that you don't try and imagine it in your head. Can you see them here? This is relatively equal lows. If you go to this time frame, you can see here. All right, so let's move on. So you can see a lot of confluences telling that price wants to go lower. Now, something happened here. You can see here is the mitigation block. You know, the breaker block is right from the mitigation block. Breaker block is you are expecting the last down close candle that was formed before liquidity was taken. Now, if that structure is broken, that candle formed will be what? The breaker block. But for a mitigation block, you don't need to see what liquidity taken. You can see that this high wasn't taken by this high. As soon as structure was broken, price returned back to what? This down candle. This is the mitigation block. Now, you combine this mitigation block with what? A fair value gap. So already you could have been using this to enter, but why can't you use that? Because this is a Thursday. So if this was a Wednesday, fine, you'd have entered. But this is a Thursday. But although you could have capitalized on this, but you don't want to be going for this model, one shot, one kill on Thursdays. So you can see how Friday retraced back into the range. So towards the end of this video, I'm going to talk about this, but let's move on. Now remember, we're in step 3. The first, you want to determine the weekly bias. The second, you want to identify the weekly open. You want to draw it out because you are using the concept called the power of 3. And then the third, you want to pair that protraction with what? An institutional level by the left-hand side. So let's move on to our entries. Good. So for the aggressive entry, you can see here, if we go down to what? The 5-minute time frame. Remember, you're going out from the weekly. So the 1 hour, is so that you can select your, identify the weekly open, then straight to what? 5-minute time frame. So you're working with what? 3 major time frames. You can as well refine to a 4-hour time frame to look for what? Institutional levels, maybe a fair value gap or another block or a breaker block for price to find support or resistance. Anyway, that's that. All right, so you can see here, this is the ICT 2022 entry model. That is the market shift plus fair value gap, which I renamed. Now, I also have other entry models, which I explained in one of my previous videos. I'll leave a link here again so you can go watch. So this is just one of it. Price did what? Took out what? This liquidity here. You can see this is what I call micro non-liquidity. And then, boom. This displacement, this aggressive displacement is a very good telltale sign. Usually, it leaves fair value gap as soon as it broke what? This market structure. So as price returns, what happened? You want to be selling. Now, one of the rules for entry is that you want to also combine two things again, which is what the Q zone and the power of three. And this is the weekly open and as well. This is also Monday's open. So you can see prices are above what? Daily open and the weekly open, and then you'll be entering where at the New York Q zone. So I took this indicator. Normally it used to be down below, but I took it here so you could see that the entry point was where at New York. So this is where you'll be entering. So when you see something like this, it's actually safe to enter because this is already at the New York open. Sometimes you can get entries even before the 8:30 when the news will be released. So I want you all to note the confluences I'm adding here. The whole idea is the one shot, one kill. And then this is what the institutional level and price is what above the weekly open. And we're looking for entries at the Q zone using what either of these entry models. So if you want to learn more about this entry model, I think I gave about 6 or 5 thereabout. So click the link by the side to watch it. It will really help you. So this is for the aggressive. So let's go to the second, which is the conservative. So I brought this here so that we'll know how it looks in the 1 hour time frame. So this is the what conservative, which happened on Tuesday, close to the weekly market open. All right. So the same thing is happening here. The market shift plus fair value gap. Now you can see that this went beyond the London Q zone. So I'd like to explain to you that for this very model, you can use the Q zone extending to 6 a.m. New York time. But past 6 a.m., you don't want to be using this model. But for day trades, you want to stick with your regular 2 to 5 a.m. New York time. But for this model, you can go beyond the 5 a.m. to 6 because your trade setup is a short-term trade. It's not a scalp or anything. Usually when I'm taking a day trade or a scalp, once it's beyond 4:30 a.m., I don't like looking for entries anymore because it's way beyond my time zone. But for the one shot, one kill model, you can go beyond the 5 a.m., but you want to stop at what? The 6 a.m. So you can see this kill zone here. You can see how price ran into what this fair value gap and the breaker block here. You can see and the price running lower. Secondly, I also like to point to you that if I were to take this trade, I wouldn't wait for price to return to this fair value gap. Because of the build up from the 1 hour time frame, I'm expecting price to be what bearish run for what the liquidity below the market, and price has shown a reaction from that weekly fair value gap. Once price rallies into what that breaker block, I'm sure here is an Asian range. Let's go back to see the Asian range. Okay, you can see here, this is the Asian range. So price was taking what liquidity above this high. Okay, then you can see this three trend build up. We have what 1, 2, 3 again. So the moment I see this break, this momentum here, I'll be entering. I wouldn't wait, and this is already at what the London. So I wouldn't be waiting for this to happen. Do you understand? This is a more safer way, or to give you a better stop loss. But usually what I would do if I'm entering like this, if I should enter with 5 lot size, I would, as soon as price breaks this low, I'll be entering with 1 lot and wait for price to retrace into this fair value gap. So as it keeps retracing into the fair value gap, I keep adding my lot size. I can add like 1 here, or let's say 2 here, making it 3. 1, as price keep going higher, I'll be adding till it gets to 5. Once it gets to 5, I stop adding. So it's just a way of building up and not missing a trade, because sometimes price can just take this low and start running lower. Now, mind you, I'm not saying you should also trades. It's okay to miss trades. It's very, very okay. It happens to me all the time. Like I see market movement and I miss it. I don't usually feel bad anymore when I miss trades because I know I'll get another opportunity. There was this period in my life when I was scared that I won't get opportunity. So any opportunity I see, I try to capitalize on it fully. I try to risk. If I miss a trade, for instance, something like this, if price is here, and I'm seeing this because this looks so perfect. Price reacting from breaker block, this model, everything. And I miss it. I would want to enter here and then my stop loss would be here. So messing the whole thing up. And if I want to enter with maximum profit, I would like to put my stop here or here. Usually price will just run, take my stop, and then keep it going lower. And it caused a lot of frustration for me. But because of practice, practice, and practice, and practice and experience, I was able to understand that no matter what, the market will always remain. The question is, will I remain? So I've come to understand that I always get opportunities. So I don't pursue trades. It just gives me this calmness, and it will come to you if you're that kind of person. So you need to spend more time in the chat, keep practicing, don't give up. Don't think that you're not making progress. You just need to keep coming, keep showing up, and everything opens up for you. Second thing I want to say is if you want to use a type of entry model, you have to understand market movement, because if I should be selling here, it's not just because price just broke this level with this fair value gap being created and this trade. No, 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 no. coming from a build up, the one shot, one kill model. Price is reacting from what? A weekly fair value gap on Monday, telling you that Monday has created the high of the week. And I expect that Tuesday and Wednesday will be bearish. Sorry, Thursday, because there was no Tuesday. But of course, there's a Wednesday in every week. So I'm expecting Tuesday, Wednesday to be bearish. Why? Again, the liquidity has not been taken yet. So I'm not expecting price to keep rallying higher. Now, if price takes me out, I don't feel bad, because I know why I'm entering the trade. I'm entering the trade because I just see this. I know why I'm entering the trade. So if price takes me out, it means I shouldn't be in that type of trade. It's a bad trade. That's what my stop loss is there to do, to stop me from what? Bad trades. So altogether, the trade is a good trade. I'll get another opportunity and again I'll enter, because I know how to trade. I have the skills. And that's why I want you all to be focused on getting the skills and not just the money. If you get the skill, it remains with you for life. And the beautiful thing about it is that it's scalable. You can scale it. Imagine trading 1 million and getting 1%. Of course, if you become a beast in this industry, you should be able to make more than 1%. But let's say you want to be making 1%. 1% of 1 million is how much? That's 100K. 100K in a month is quite all right, guys. Very okay. Very, very okay. All right, so I promised earlier that I'll talk about this trade. Now, another thing we can also do with this one shot, one kill model is you mustn't take the full trade. Some of you are not short-term traders. Some of you are just scalpers or day traders. So you can as well use this one shot, one key to build up on your day trading and scalping. So what you want to do is to start from step one, identify the buyers of the week. Then step two, you want to apply the power of three or draw out your weekly open and then wait for price to go above it. So you could either go above it on Monday, Tuesday, or Wednesday. You just want to see price going up. But sometimes it doesn't even work like that. It just gets messy. But building up like this increases your chances for profitability. So you could as well just be taking day trades here. Now, if price goes above this high, you just take a sell from here and then taking your profit here, somewhere here, and you'll be good. Then you come on Tuesday again. You can see this is a breakout block. As soon as price hits it, do what? You sell and then take your profit here. And that's okay. And you can see there's another liquidity here. Now this liquidity is still there. Let me just go back quickly so we can see what the liquidity is. Mhm. So you can see that the liquidity is still here. This is Monday, this is Tuesday. Tuesday failed to what? Take this low. Good. So now this is what? The Thursday, because Wednesday there was no trade. All right. So you can be going on what? On a Thursday to do what? To sell again, because you're just following this model, but taking your day trades or your scalp. So you will still leave this line here as you keep taking trades. You don't expect price to what? Go above this market open. Now it can happen, but the likelihood is lower. It can even happen on Friday, but you are done once it's Friday, because Friday usually post a retracement in the weekly range. You can see this is a weekly range. This is the high. This is the low. You can see how Friday retraces. It's just go and check your chart. It happens like that. Not all the time, but usually you see Friday retrace, because it's just common sense. This is the candle. You know, this is Monday here. This is the open. You can see here. Look at how Monday went up. And you can see how Thursday created the low of the week. And then Friday retraced into the week. So usually you always see this in your weekly time frame. It happens all the time. So regarding this concept, I explained in one of my previous videos, the TDI model, which is thank God it's Friday, where you take advantage of this concept where price retraces, where Friday always retraces into the range of the week. Now, I didn't take a trade this Friday because Friday did not take the low of Thursday. If you have watched the video, I explained that for you to capitalize on that TGIF model, Friday has to form the low of the week. Had it been at London session, price rallied lower, I'd have been looking to take a buy here. Maybe a shift in market structure in the 1 minute time frame or 5 minute time frame for a buy. But I didn't see that here, so I didn't take any trade here. All right, so we're talking about Thursday. Here, at this point, let's go closer. Let me show you something. Already, this is what the mitigation block, and this is a fair value gap. So you shouldn't be scared. Don't be scared thinking, price, what if price keeps going higher? Well, if it goes higher, then you lose the trade. You sit back and wait for another opportunity. It's as simple as that. Because based on your understanding, price should run lower. You want to follow your rule, you want to follow your plan, follow everything because these things keep repeating themselves. So now if you look at this point here, there's a small fair value gap here. Like I can't expand this more than that, but there's a small fair value gap here. You can capitalize on that fair value gap. Then another thing again is this is an order block here. So now there was a time this candle went below this order block. Remember, I explained in one of my previous videos on order blocks. What validates an order block is when, if it is a bearish order block, the low has to be taken. So you can see how price went below the low of this candle. So it validates that this candle here validates what? This order block. So you can see how price went below it and then went back into it. So here, price is what? Price was mitigating this order block. So you can see how price went below it, taking its low, and then went back into it. So this move back into it is a reaction of this order block to run lower. So I don't know if you understand. So if you go down to a smaller time frame, we'll see it more clearly. All right, so let me take this. Let's go. All right, so before we go to a lower time frame, I want us to see something here. So you can see that three pattern being formed there. This is 1, 2, 3. Although this high failed to go above this high. So when you see something like this, you can as well be looking for what? Smart money divergence. So you want to compare this with the DXY. And that's what I did. There was what? Divergence here, which was further increasing the likelihood of price going lower. So let's look at it quickly. So this is the Euro USD. This is DXY. So you can see how this high failed to take this high. Dollar made a lower low, but Euro failed to make a higher high. So this is what smart money divergence happening where in that fair value gap, reacting from where the mitigation block, building up this whole concept from where the one shot, one kill model. So because of this understanding, these confluences blend together to make a lot of sense for us. Okay, so let's go forward. All right, so this is the 3-minute time frame. You can see the smart money divergence, price reacting at the mitigation block, the fair value gap happening where above the daily open. So you can see price above the daily open happening where the London Q zone. So this is a lot of confluences telling you that price wants to go lower. So I actually took a trade. That's what this number signifies. I took a day trade here. You can see at 1.03624. At this point, this is where I took a trade. Let me show it to you. So you can see 1.03624. And then this was when I closed. This was first. This first represents January. Second is on Thursday. Second was Thursday. So you can just check. You'll see that second was Thursday and then 2025. This time is being read in Nigerian time. It's not the New York time. You can see that I made $18.9. It's because this was what I needed to pass or complete phase 1. So I didn't need much. That was why I closed at this point. In fact, I think the market closed me out once I got to 8% of my profit. So let me explain something here again before we move on. This was where I entered. Now, why did I enter here? Already because of all these confluences. I don't need any market shift plus fair value gap or inversion fair value gap. You can see there's no fair value gap here. All I needed was that displacement. You can see this displacement here. If you go to the 1-minute time frame, you will see fair value gaps. But this 3-minute time frame was what I used. As soon as I saw this, because there was what? Divergence. Price was already above, and like I explained before, it must not enter above the market open. So this is the market open here. So I had already seen this move, telling me that price has already protracted. So there's no need for price to keep going higher again. Price wants to go lower. We are selling. We want to go. And I explained for that liquidity has not been taken. So there are a lot of confluences. So I don't need price to start creating that fair value gap before I enter. And that's why I've always been stating it to you guys. Entry is not your problem. Entries are not your problem. You just need to understand the market. Don't be too worried about how can I enter? Where do I enter? No. Although they have their relevance, they have their place. But if you understand market movement, if price had even got to this point, I could have still been entering. Because where my stop is here, it's not too far. The risk is okay. Because I'm also looking at where the liquidity below the market. And this is just London. Market has not moved yet. And I know that price move daily at an average of 50 to 70 or even 100 pips per day. Just go and check it yourself. So this could just be like, let's say 2 pips, 8 pips or so. Let's go to the how many points? So this point here, this is just I think this is 9.9 pips or so. That just made me this morning. Can you see? So I was able to enter here because of all these confluences telling you that price wants to go lower. But for you as a new trader, let me show you how you could have been entering. Now this is the 5 minute time frame. Already this is smart money divergence because you remember the ICT entry. So price will take out this high before breaking this low, and fair value gap will be entry. So you don't need to see price break this high again because this is what divergence. If you go to the dollar, you can see that thing happening here. Took out this low, broke this high, and then this is fair value gap. Price rallied higher. So you don't need to look for that micro non-liquidity. So once you see this break, market structure, this market shift, you can be entering with what? This fair value gap with your stop where? Here. This is fine. So you can be entering, and this is what this is the London what? Q zone. And price has gone above what? Market open. This is the market open. So this is what you can be using to enter this trade. All right, so the potential reward you would have been getting from this trade is one shot, 1 kill. If you'd have entered here, taking your profit here, no, remember that liquidity that equal relatively equal lows. You'll be getting a reward of 8 hours, meaning if you reach 1%, you get 8%. So imagine just having this one setup in a month is very okay. And mind you, this setup repeats itself every single month. I promise you. Just check. If you're the person that trades the forex market, you can be looking for this setup for in the euro, in the British pounds, basically in the USD pairs. You can be looking for these setups in the 7 USD pairs, practicing them first, getting a handful of experience before you want to go into the live market. So imagine getting 8 hours, 8% in one trade for a month is very okay, guys. So if I've held to the end, definitely, I don't think the likelihood of you taking your profit here is very, very low because you may not be able to call uh the extreme low of market move. But there are ways actually you can actually determine that price will end here, and that's just advanced stuff. Anyway, you don't need that. You don't need all those things. You just need these basic things to make ends meet. Now, you'll be getting what? 17 hours. And that's actually a lot if you'd have held. And another thing again is you need good market understanding to know that price will keep running lower. Imagine you entered here, market has gone to this point. When you start seeing market going like this, you start getting scared. Maybe you start moving your stop loss also, or maybe you may be taking out. Now, it's not always like this. Sometimes you see market even go. Let me show you. Market will be entering here. Market will start misbehaving like this before running lower. Usually this happens. So be mindful. All right. So if you'd have used the conservative entry, you'd have been getting what? 6 hours if you took out your profit at that liquidity, which is very safe. Or if you held it all through, you'll be getting what? 15 hours. Now, mind you, one very important thing you want to do is you want to be taking partials. So as soon as price takes what? This low here. Let's say you entered here and you see price taking out this low. You want to take out what? Partial. Maybe like 20%. Then if you see price taking out this liquidity again, you want to take another what? 50%. Leaving how many percent left? 30 or 20. If you want to leave any percent on any trade, it should be 10 or 20% after taking a bulk already. If price has gotten to your what? Liquidity or your take profit. Anytime you want price to run, you want to leave like 20 or 10% so that you are not affected by the movement. So that extra profit is just to cover your previous loss or future losses. All right. I hope this was helpful. If you enjoyed this, please give this video a like button. And those of you that are not subscribed yet, please subscribe. I wish you all good luck and good trading.